an empty property and I'm selling it and you're asking me to wait 30, 60, 90 days, then I negotiate back covering some of my costs, right, as a seller. Because why would I want to pay another mortgage, another tax, another set of utility bills just to hold it for you, right? So if they really want the property, allow them to pay the costs is what that's how I see it. So, and I know that's on the other side, but we're all going to be on one side or the other at different times. So as a seller, you have the right, if a buyer is asking you to wait, have them assume the associated costs.
Mhm. Just thinking of if we have any scenarios like that.
Oh, I sold a condo in Brampton like that. My realtor at the time was like, oh, well, she doesn't need it until September. I'm like, yeah, but it's June. It's available. And she herself was an agent buying it. And I'm like, I don't care. I'll hold it till September for her because she's offering me, her offer price was good, but I'm not carrying those costs for those 3 months. So she carried the cost for the 3 months. And it was mostly because she was waiting on a divorce settlement, why the time was being requested. So,
Mhm. So yes, again, always depends on the market you're in. A seller's market is not a time that a buyer can negotiate much of what they need out of it. A buyer's market is obviously the other way around, and a seller is doing everything they can to get their property uh, out and offloaded. So it really depends on the market you're in. Okay, so in terms of down
I
payment,
hardly remember a buyer's market. I remember more sellers' markets.
I think we're definitely in an extended seller's market at the moment. It's
It's been too
built over.
long.
Mhm. And as much as everybody's talking about a bubble and so on, it's really the factors don't seem to be looking good for prices decreasing and it becoming a buyer's market anytime soon either.
Yeah.
So down payment. So obviously, and maybe it isn't obvious, but in general, a higher down payment will help with having a higher down payment will help with your offer and your purchasing and your financing. So one, it's a lesser risk option, and but when we think of some folks who may work with us and may be looking at this, they don't have the option or they don't have the option to do the 20%, but it definitely does help. And when lenders are looking at it, the 20% is what will help you get approved more easily. Um, your mortgage insurance won't cover your investment property. So for example, if you were trying to do 5%, so usually an investment property, no matter what, even if it's your first property, they will expect you to do 20% down. So as first time buyers, you need to definitely not look at your first property when you're looking at financing and call it an investment property. It is a property you're usually buying to live in. And so you can get mortgage insurance, but if you call it an investment property and you won't be living in it, you will have to do that 20% down. And if you put 25% down, you may get a better interest rate. You have to talk to your lender and see if that's possible. And in terms of your down payment, you can get a second mortgage on the house. So Andrea, is it that we can get a down payment and a second mortgage when you're just going in, or you have to go in with the 20% and then get a second mortgage to get that 20% out?
Yeah. So if you, it's just that people don't realize that you can do them almost simultaneously, right? That you can establish and set up a purchase and still get that HELOC, or like it's not always the case that you can add that second mortgage or that HELOC to it, Kemba, but it is possible to do both at the same time, or one right after the other. Like you get the mortgage and down payment settled, and then shortly after you can negotiate that second.
Mhm.
Oh, a HELOC. So Kemba, here we're starting to just get into just your financing options. And
Mhm.
that's a good question, Andrea. I shouldn't be using acronyms without saying. So HELOC is a home. So each letter stands for the home equity line of credit. And so if you own a home and have built up, well, typically, when you buy it with 20%, you already have equity in there. So in order to unlock and have access to the equity in your property, a bank will provide you with a second mortgage, often referred to as a home equity line of credit. And that amount you can utilize it, you can utilize it to make additional purchases or use it to do renovations on a project if you've bought a home with work and need that needs to be done.
Mhm.
Okay, so Kemba, it is possible to have them both at the same time as well as one right after the other.
Mhm. Mhm. And these are strategies that you speak to the broker about. Generally, it's a broker who would sort of help you
Mhm.
work that out. The banks, especially the big five banks, are not necessarily always open to doing deals like that, but a broker may be able to help you figure out how you can do a creative deal like that as well. From a down payment perspective, getting private money or personal loans may help you to get that down payment, and that's how you do your 100% financing, where you've loaned the money and then you're using it for your down payment. The banks do want to know if you are using borrowed money, and in some cases they're not approving of that, but in other cases they may consider it depending on the situation.
But they are willing to offer you that equity if you are willing to apply and negotiate for it.
Okay. Uh, the difference between a pre-approval and approval is, so a pre-approval is just it's an estimate. It's a let's look at your high level, what your situation is, and yes, we can approve you um, for a certain amount. It allows you to go out shopping for property with an indication of what you would get in financing, but it is not a promise of financing. It's just an indication. Um, they're just giving you a ballpark number of what you could shop for. With a pre-approval, it's recommended that maybe you don't go over your pre-approval unless you know there's monies you have or income you have that you haven't reported as part of your pre-approval, which will help boost how much you can get. But still, it's important to maybe share everything you know you'll be using in the purchase, from an income and resources perspective, like down payment, deposits, everything that you're going to use, so that they can give you an accurate number of what your pre-approval is. Your approval is now the actual specific amount that you would be getting. It's also not binding per se, but it is a stronger, because they've checked your credit, they've done more checks on you, so you have a firmer number as to what they would be willing to lend you. But at the same time, when you go into making the offer and then you're at the point of checking your finances, that could also change. It's not binding either. It usually does land, because they've checked everything, it does usually stay aligned. But if something in your details changes, or the property, the property appraisal doesn't come in where it should, and so on, your approval, even if it's say 500,000, if the property is appraised at less and you've offered more, your approval doesn't matter. They're still going to lend to what the value of the property is. Banks and mortgage brokers. If your down payment isn't quite as big as your purchase, seek financing from a bank. Mortgage brokers are also a good option to access a wide range of loan products. A fixed rate loan has the same interest rate as for the entirety of the borrowing, while variable rate loans have an interest rate that changes over time. So in terms of, who you're going to use, a bank or a mortgage broker, a lot of the times when you deal with one bank, they are willing to, if you have a long-standing relationship with one bank, they're willing to tailor your deal and give you better rates, better financing, conditions, and possibly give you more flexible lending. When you're new to a bank, they're not as willing to offer you any extras or special features or lower rates. And definitely a mortgage broker is able to shop at multiple banks to give you options to get a mortgage. Has anyone heard of vendor take back? Seller financing? So seller financing is when you're able to get almost like you're getting your mortgage from the seller. So the seller retains an interest in the property. You pay them an interest rate, and you will be basically paying them as your bank. And that is how it becomes seller financing. So they've turned over the property to you, but in your offer that you make, you do have to write in at that time the offer of seller financing, where you're writing into the offer the conditions of asking the seller, okay, I would like to buy your property for X amount of dollars. I have mortgaging of this much, or I have cash of this much, and I'd like you to be my hold the financing for the rest. And you give them a time frame, and you give them an interest rate that you would pay them over that time. And the vendor take back means that if you're not able to meet your commitments, what ends up happening is the vendor, who is the seller, would just take the property back and they would own it again. So if you offer to do seller financing and they agree and you aren't able to meet those commitments, you would just, the same way you'd lose your property to the bank because you've committed that to the bank, then it's similarly you'd lose the property back to the seller. Andrea, did I miss anything in terms of vendor take back and seller financing?
No, they're just great options and strategies to use as well, right? To help finance your deal. You don't have to use the bank.
Yeah, and again, this is not an option that many sellers are familiar with. And so sometimes if you were to go into put in a seller financing option into folks who are not necessarily familiar with investing, they would maybe abjectly reject it because they don't understand it. And as well, in a seller's market, they don't necessarily always need to do seller financing. And so they may reject it for that reason. Under other circumstances,
but there's times where they might like it as well, Kemba, because if they're selling right now and they still have a 3+ year or 5-year commitment, right, and a fixed rate mortgage, there may be benefits to them to accept your offer, so they don't have to pay out that 30,000-40,000 in interest that they would owe to the bank.
Mm-hmm.
So
and another reason too, it's as a tax strategy for a seller. Sometimes when they do vendor financing, they don't have to claim the capital gains in that year, and they can push it to the year where that seller financing is discharged. And so it sometimes is a strategy from that perspective, where they're willing to negotiate with you and on those terms. Yeah, knowing what the seller wants is a very good thing.
Exactly.
To help you,
and what's like what their current situation is too, because if they are if you help them understand that they're going to be paying in excess of 30,000 to 50,000 to the lender, and that you could assume that mortgage, or that they you could have an arrangement, it might be appealing.
Mm-hmm. Yeah, well, assuming the mortgage is a little different, only because some mortgages are assumable, and what the bank would do is it would just sort of, in a way, port the mortgage to the new owner. But the seller financing, you actually have a loan with the seller. Personal loans and private money. So another way to get your financing together and get enough money to buy a property whether you're doing the full mortgage with, or you're just getting a portion of, so your down payment and deposits together, is to get a personal loan from someone you know, or someone willing to lend you money. These are,
Yeah, it's a great option. People don't often think about it, but you can ask family, someone who knows you well, right? As long as you establish some agreements and some legal agreements that protect each of you.
Mhm. Although parents don't realize that they're usually giving personal loans to their kids to buy
But
property.
because they can refer to it as a gift as well, too, right? To the in the case of parents, it might be gifting to the children.
Mhm. But you can also do a personal loan to a child, a sibling, a family member, and it does keep more accountability, because it's clear the terms. You may not want to collect interest, because the reason you're giving them a loan is that they don't have other resources. So you may not want to collect interest up front, but you could tie it to the property and say, when you sell, or when you refinance, or you can get your loan paid with a little interest or no interest at all. It really depends. But personal loans um, are a good option, and can sometimes be cheaper cash than the bank, because family and friends may not charge you as high an interest rate as, say, any other lender out there.
I'm going to.
Sorry, did somebody have a question?
Yeah, I just put thoughts around using a line of credit towards your down payment. What are your thoughts on that?
That's absolutely what you have to do. It's totally something you can do. It's also why we encourage people who already own property to say refinance and get a line of credit, or have that extra income. And what you would basically do, Tanya, is you would be looking at what the cost of that money is. Usually it's low. It's around the same amount as what your mortgage is, maybe a little more. And that money is flexible, because you can pay it off. You can, but it's a way to access a lot of capital that will allow you to invest elsewhere. Does that
Yeah,
answer your
if
question?
it's the rate is better if it's a home equity line of credit than if it's just a line of credit.
Mhm. Did you mean just a line of credit, just not something tied to your home?
Yeah, so a line of credit or the home equity line of credit.
Okay.
Yeah, the home equity line of credit just has a slightly better rate than the line of credit, but they both can be used as long as the property or the investment that you're making will return greater than the interest, right? Then it works and it makes sense.
Mhm.
And in most cases, properties do bring back a greater amount than the rate that you pay to borrow.
Mhm. Yeah.
So it's an excellent way to finance your investment opportunities.
Yes. And a good way to look at it, like an easy, simple calculation, is on a line of credit, you'd be paying, say, 3.5% or 4%. I don't know. It depends on your line of credit and when you negotiated it and so on. And then on a property that you buy, the appreciation in that area, and for the same property type, you look at what that appreciation is, and the appreciation year over year has been, say, in the ballpark of 10%. So really, even just on the appreciation, not considering any rents you'd be collecting or anything like that, the amount you're appreciating year over year is greater than what you're paying on that line of credit. That's a simple, basic way to look at it, but there's other factors you can consider to say, is it worth it that I should spend the money on my line of credit to then invest in other properties? So just private money is a good idea. It's usually easy to access. The qualifications are less than, say, a bank. They are, given by professionals, like it's a regulated industry in most cases, or there are people who are like private lenders, but they'll lend through a mortgage broker. The documents and everything that you do are, with a lawyer. It's very clear. I mean, it really depends on the private lender you use, but it's usually very structured. Because it is private money, a lot of the time it would be of a higher interest rate. And on the flip side, anybody can actually be a private lender. It doesn't necessarily, it's not a, you're not allowed to be a private lender. You can lend money if you have, and so you just have to have all the right documents in place. It can come from anyone. Investors can negotiate more flexible terms with their private money because the entire transaction is less business oriented. Private money lenders rarely receive any additional cash flow based on equity other than their own. So private money is always just a good idea if you have been turned down or not able to access capital from the major banks. It's just you'd be maybe spending a little more on that private money, because to mitigate some of the risk that a private lender would have, they're charging you more money to borrow that they're charging you more interest to borrow that money. Andrea, any other point about private money?
Yes, private money could also be short term, like you could use it just to help you close a deal really fast and get it at the price that you want to then later secure a mortgage. So there's no harm in considering it despite the rates, because the benefits can be significant, right?
Yeah. So and that may be sometimes how people are putting in cash offers too, right? They're able to have private money on hand, and then they figure out the financing after.
Because you can buy yourself 6 months to a year on private, and still the deal will work and the numbers will work.
Okay. So cash out refinance for real estate is a transaction where you tap into the equity in your home, and we've kind of covered that a little bit. Borrow enough to pay off the mortgage.
Yeah, so I think here we're just highlighting the two ways that you can kind of access money from your property. You can do it as a refi, right, and take it out. So if you know your renewal date is coming in the next 6 months to a year, or whatever the time frame is, you could plan to do a refi and take the money, a refinancing, and take the money out at that time at renewal. Or in the event that you're not close to that, you could negotiate with your lender to do a home equity line of credit instead, right? So both options gives you access to your equity and allows you to use that equity in ways that can create and build wealth.
Yep. And I guess to be clear, like the cash out refinance is that you're refinancing over and above what your up to the 80%. So you've gotten equity in your property, it's appreciated, and so now you're refinancing back up to that 80%, and that money is paid to you in cash, and then you can spend it as you see fit. You will obviously have that mortgage commitment, whereas the home equity line of credit is just a line of credit, and it is still 80% of the value of your home potentially, and you use it as you need, right? So there's the two sides of it, right? Okay, another option is registered
Using your RSPs, right? So some people don't know and are not maybe knowledgeable, but you can use your RRSPs to make your purchase and provide the down payment for a property, right? So in most cases, you're allowed both partners, if you're a husband and wife, or if you have a partner, you both can take out of your RRSPs and pay back over time. And we'll just kind of spell out some of that here. If if it's, I think the amount right now is what, 35,000, I think. That you can use, like each person. So you have limits that you can take up to, and you have time period in which you have to pay it back. But it's accessible as well as a form of down payment.
Mhm. You can lend against your RSPs too, can't you? Like you can use it.
Absolutely, yeah.
Mhm. And so, for example, with private lenders, you know, sometimes that is where they would, if you don't have other security to offer, you know, they would say that that's something you could use as collateral too.
Yeah, so you can invest your RRSPs in mortgages themselves and get better returns than you might get at a bank or on a mutual fund, and get better returns. Yeah. So you
Mhm.
can leverage them.
You can leverage them. Okay, commercial real estate. Commercial real estate refers to any income producing real estate that is used for business purposes. So offices, retail, hotels, and apartments. There are 4 C's when considering: capacity to pay back the loan, the capital, collateral, and the credit. So in many cases, what they say with commercial financing is that the borrower is not as a significant portion of the approval as is the property itself. And so many times they're looking at the property itself to make sure that it will carry the cost of what you're refinancing, or you're financing on it, or you're offering on it. You as a borrower are looked at to a certain extent for experience, ability to manage, and different things, but in general, it is the property that's getting approved. It is a good option sometimes when you have capital, but you can't get approved personally. It is a very good option to consider to go into buying real estate as a business. And so you can get approval as the business. Okay. So we're at the end. Consider ways you can fund your deal. Think of non-traditional ways to finance. What would this method help you get to do in the real estate industry? So joint ventures, selling and vendor take-back mortgages, personal loans, private financing, home equity lines of credit. So not including any of the banks and mortgage brokers. So consider like your personal situation when you think of this exercise, and which of these activities or things would help you in your situation. And based on what we've discussed tonight, which ones do you think you could use as a tool to help you get into investing and property?
And I think that this exercise is to help you think outside of what you've already been thinking. And most people think, which is that they have to save up to buy their properties or first property or their next property. But we're trying to show you that outside of your savings and what you have as resources, there are other ways to finance your real estate purchases.
Mhm.
So think of maybe 1 or 2, maybe 3 of these that you could utilize to help you, get into real estate, or help you buy additional real estate if you already own.
Mhm. Any questions, guys? Do you have questions so far?
I do.
Okay.
Seller financing and vendor take back mortgage.
Mhm.
Now, question, as you guys know, our property, we've been here for 15 years and we've got good equity into the property. Now, just thinking outside the box here, let's say I want to sell my property now, right? And I want to do a seller financing. This is another way I can actually make some more income off of the property by financing it. Is that correct? Or
That's correct.
Yeah, it is correct, because you're asking to have a stake in it,
Right.
additional, beyond the period of time that you're there, and now you've moved out, you've sold it to the next person,
Okay.
and you can still continue to earn on
Off
it. And you
of,
can also ask them to have a portion of it mortgaged, because you want some capital at the sale, at the closing, right?
okay, understood. But let's say, I can sell it for, let's say, $1 million, right? And I can, with my equity that I had in it, I have more than that to buy another property. I move into another property and just finance that million for them to pay me as a bank, in terms that way that they're paying me the interest rate that they would be paying the bank. Obviously, I'm going to try to take a lesser interest rate that they get from a bank, but I'm still making an income off of that. Now, my other question is,
Typically, you're going to ask for a greater rate.
Yeah.
Because you're a capitalist and you're trying to earn. So
no, but I would think
you're not
of
going to
it
give
as-
them a better rate than the bank, Sunil. You're actually going to ask them, because it's like they're trying to negotiate with you, and they're trying to possibly, they're not able to be financed through a bank.
Okay.
So you're going to charge them a greater rate.
Understood. But I was just thinking, if they have the affordability to get a good rate from the bank, right? I'm just
Mhm.
thinking of, I'm still going to make income off the property that I'm selling them and be the
Mhm.
bank in their eyes, right?
Mhm.
Now, obviously, off the sale of the house, there is no capital gains tax on that. Now, the interest that I'm going to collect from them, there'll be capital gains against that, correct?
No, the interest
Income
will be,
tax.
it will be income. It'll be income, so it's taxed as income. But
Okay.
any gains beyond the price that you sold to them, and I guess anything that you realize on that, like
Mhm.
during the time of ownership with them, some of that could be subject to capital gains.
But
Like,
even if it's
say you sold it $1 million, but by the time they close it out with you, it's worth $1.1 million.
right.
That 100,000, some of that could be gains in the eyes of CRA.
Of the
and
CRA, okay. Okay, good to know.
Mhm.
Thank you.
Sunil, it made me smile because it felt like, tonight we taught you something that you were like, I can use that.
Well, and that's what we're asking you to go and do
absolutely.
with this exercise. Think about it.
Absolutely.
Yeah, they're not stuff that you thought of before. They're not
No,
things
they're
that I
not.
knew
They're-
at the
they're
beginning
work.
of making my first purchase way back when. But there are things that we've learned that we can do and that
Yeah.
we've been able to do to build.
Absolutely. I've heard the term seller financing. I kind of got the concept, but I just, had some more questions, obviously, to solidify what I understood about it. So,
Yeah, you can be the bank.
yeah,
You can
that's
be
what I want. That's what I want to be.
Exactly. We are capitalists. We want to be the bank. We don't hate them. We just
No,
want to
no,
be
no.
them.
Well, we want a piece of the pie too, right? So,
Exactly.
thank you, ladies.
No problem. Any other questions?
I had a question on the RSP, sorry,
Yeah.
financing. So that's no longer applies to just first-time buyers?
In general, with the banks, it does. So if you're getting a mortgage for first-time buyers, yes, but there are private lenders, private companies. There are ways to leverage your RRSPs into
Yes.
real estate investing, where you're not a first-time buyer.
That's right. I have a lot of RSP money that between my husband and I that we've put into either land deals or projects that banks don't often finance, but private companies come to us to borrow and we'll lend at greater rates and get good returns. So we're just showing you can use your RSPs and put it to work for you too, outside of being a first-time buyer. And the whole sum where the first-time buyer is limited to the 35,000 or whatever that amount is currently. I apologize, I didn't look at the number right now. I think it's 35. Your whole RSP savings could be moved into your whole RSPs could be moved into land development or other real estate funded projects.
Okay.
Yeah, you can, if you're interested in knowing more, you just ask us more at a later time.
Okay.
Okay. Let your RSPs work for you and build greater capital. We're talking more like double-digit returns in many cases compared to what they may be earning.
So Andrea, just about the RSPs then, what's the fee for taking it out?
Oh,
mean-
we never take it out, Tanya. That's really important. It's just a transfer.
Okay.
So, yeah, so because we can't take it out because then you do realize fees and there might be associated fees to move it from the where it currently is, and you would evaluate that in your, you know, transaction that you're doing, but we don't actually take it out. It's just paperwork, right? Paper to paper. Yeah.
And an example of a fee though is like, so currently say you have your investments with Manulife, but you would need to move it to a company that would manage your RSPs and allow it to be invested in mortgages or to get that return. I think a fee I've seen is $160 a year. That's their fee to hold your RSPs.
No, but I think you were, in everything you do, someone's making money. But I think the only fees that I'm thinking of when you move it outside of, I agree with Kemba, the organization that manages it will have like a managing fee, right? So too does the organization that you're with currently. They do have their MERs or, you know, their fees. And so if you're in a declining sales charge on some of those transactions, there may be associated costs when you move it that way. But we're never taking it out of the out of that registered plan. It still stays registered and moves from, it's just paper to paper.
Mhm.
Yeah. I think if you were asking, because we can't cash it out, it will create tax challenges. And you can do that with RESPs as well. I heard Andrea say it more than once. There are sometimes opportunities as well to invest the RESPs similarly as your RRSPs in real estate.
Mhm. The possibilities are endless.
And yeah, and you just now know that they are if you didn't before. And you can make your money work. I mean, the whole point of building wealth and becoming the rich is to put your money to work and you work a little less. And that's what we're hoping to educate you on.
Okay, guys, so we're like one hair away from 8:30. We do appreciate you every night to come join us and learn and ask questions and just engage. So thank you so much, everyone, for coming on. We'll send a wrap-up email.
Yeah, just
Sorry.
remember the next date. The next
Oh,
date.
the next date is June 2nd, 7 to 8:30.